take it back just for one night. Take all the wrongs and pretend that we're alright. Feel the rhythm in our souls, let them entwine. Cause you don't know how much you can do to me. It's not fair, I don't care. Take you there, make you mine. Before we're out of time. Let's synchronize. Let's synchronize.
Hello guys, we are accounting student from State University of Gorontalo. In this video, we will explain about inventory account.
Trading companies and manufacturing companies always have inventory in stores as well as inventory warehouse.
Inventory must be owned because it is a company product that source of income.
Inventory is one of the most important company assets because it directly affects the company's ability to earn revenue. Therefore, the company must be well managed and properly recorded so that the company can sell its product.
Well, then we will present the material about inventory account. So, check this out.
Okay, now I will explain about inventory of stock. The first, I will explain about definitions of inventory. Inventories are a number of finished goods, raw materials, and goods in the production process owned by the company for the purpose of being sold or processed further. Next, inventories are assets owned by the company for sale in normal business operations or goods to be used or consumed in making the goods to be sold. In the calculation of loss or earnings, beginning and end, inventory affects the cost of goods sold or HPP. HPP equals initial income plus net buying plus final supplies. Next, I will explain about inventory trading company. Inventories are goods purchased by a company for the purpose of resale without altering the form and quality of the goods. Or it can be said that there was no production process since the goods were bought until the resale by the company. B. Inventory industrial company. The definition of inventory for industrial enterprises is goods or materials purchased by the company for the purpose of the further processing into finished or semi-finished goods, or maybe the raw materials for other companies. This depends on the type and process of the company's main business. Next, I will explain about types of inventory. There is raw material, goods in process, and finished goods. The first is raw material. The inventory of the company to be processed again through the production process. So, it will be semi-finished goods or finished goods in accordance with the activities of the company. B. Goods in process. It is goods that still require the production process to become finished goods. So, the inventory of goods in the process is strongly influenced by the length of production. Is the time required from the moment the raw materials entered by the production process until the completion of finished goods. And the last types of inventory are finished goods. It is the goods of production process in the final form so that it can be immediately sold on this inventory. The size of the finished goods inventory is actually a matter of coordination of production and sales. The next explanation is the purpose of inventory valuation. First is, in its effort to matching costs to relative revenue so that generate income. This process is basic purpose of traditional accounting. The emphasis on net income calculation based on revenue at the time of sale requires a cost allocation to the period in which the reported revenue is cost of goods sold. While the value of unsold inventory will be taken to the next period in the company's financial statements. The second objective of other inventory measurements is to present the value of the finished goods in the balance sheet component or financial statements. The third purpose of inventory measurement is to help investors to predict cash flow in the future. That is seen from the amount of inventory as resource that will support the cash flow and the amount of inventory that will be sold later in the day and will affect the cash outflow. Okay, this is the end of my explanation. The next material will be explained by my friend. So, thank you.
Okay, I will continue to explain about inventory or stock. Determination of inventory quantity. 1. Stock of name. The calculation of goods at the beginning and end of the calculated period. This method is a profession that must be done by management to determine the amount of ending inventory as one of the requirements to obtain unqualified opinion. 2. Using perpetual recording method. 3. Using the combined method of perpetual recording method with stock of name. 4. Using valuation methods based on aggregative relationship is gross profit method and realized inventory method. Next, A. Method of stock of name or periodic method. Inventory, which is a component of cost of goods sold, CGS, hence calculate of quantity of stock which is done with stock of name depends of completeness of data or not and calculation of goods. Next, B. Perpetual method. In this perpetual method, there is a disadvantage when determining the value and quantity of goods. Since by this continuous record method, it means that the inventory balance at any given time can be known. But it should be not that simply calculating the amount of goods based on the records will result in the value of overstatement, inventory broken, etc. Next, C. Aggregative method. In this method, the difficult is similar to the difficult experience perpetual method. If in the case of the discussion is the issue of determining the price of inventory. Next, basic inventory valuation. A. Output value. For the concept of output value, there are three concepts that can be used are the concept of discount money receipt. This concept emphasizes that inventory can be assessed by discounting cash flows in the future provide that 1. The value or price level is stable and there is a high degree of certainty. 2. The expected cash receipt timing is sufficient to provide certainty. Next, Sarah's selling price. This concept emphasizes the value of inventory based on the selling price or market, so that a fixed price is required. So for this concept, it is required 1. A controlled market at a stable price fixed. 2. There is no substantial additional cost component or material such as interest or discount in the respect of process from sale. Next, net realizable values. In this concept, the calculation of cost arising from sales such as sales discounts should be taken into account in net sales value or net realizable values. Then this concept is the concept of current output value minus the current values of all additional costs such as billing costs, sales costs. Bulletin number 43 states, only in special condition can inventory be expressed with value above cost. In this bulletin, the concept of cost is the main basic concept for inventory valuation. So the concept of pros and cons in accordance with the concept of current selling price above, while the concept of bulletin number 43 required 1. The possibility of direct marketing of the quoted price. 2. Interchangeability of units. 3. Additional charges can be taken into account. 4. There is an element of difficulty in determining the appropriate cost assessment. B. Input values. Measurement of inventories with input value is a measurement of the resource used to be optioned inventory under current condition. So that for unnecessary inventory, the interpretation of input values is very clear because the input values here describe the current from the cash that has been issued actually. The concept of input values is basically expressed by historical cost or can also be with current cost or standard cost. Current cost here use the concept of net realizable values minus normal gross margins of net realizable values. Okay, this is the end of my presentation. The next presentation will be delivered by my friends.
Okay guys, I will continue my presentation about inventory or stock. Okay, concept of supplies. Historical cost. In this historical cost method, inventory is measured based on payments made in the past or should be done in the future to obtain goods or service. Therefore, in the payment is made in the future, in the inventory price must be discounted to get the present cost. The next advantage of this concept: 1. Inventory of raw materials and merchandise reflect to actual price. 2. Under certain pricing condition. This concept a valuable alternative to net realizable values as a predictor. 3. Inventory value is not affected by management policy. 4. Assessment with cost allow accountability of cash and other sources to obtain inventory. And the weakness of the concept. 1. For absolute goods, inventory and a dated value and the goods cannot be adjusted the price. 2. There are different prices difficult to compare. 3. The large number of joint cost element and allocation methods that make it difficult to assess in inventories. And the last, matching between revenue with past cost is less prices. Next, B. Current replacement cost. The concept is to reduce the disadvantage of historical cost concept. Many authors and accounting replace committees suggest using the CRC concept to measure inventory with consideration. 1. CRC allows to matching current input value with current revenue over current operation result. 2. CRC allow identification of holding gains and losses. 3. CRC is the current value of event. And 4. CRC enables reporting of current operation profit to be used as prediction of cost flow in the future. And next, net realizable values least normal markup. In this concept, inventory is valued with the concept of realizable revenues least the normal gross profit margin. So the value of inventory is the value of acquisition according to the concept of realizable. Next, standard cost. According to ACPCA Bulletin number 43, standard cost is acceptable if it is predictably adjusted to reflect the present condition, so that at a standard cost balance sheet date it is reasonably approximate cost based on one of the recognized means of valuation. Next, the cost shall be supplied in subclasses. A. Product cost. Product cost is the cost that is taken to the inventory and recorded in the inventory account. These costs are differently related to the transfer of the buyer's business location and the conversion of the goods to a condition ready for sale. Next, cost period. Such costs are called conceptual cost periods. These expenses is the cost of the product as well as the initial purchase price and freight cost. And the last, manufacturing cost. Manufacturing overhead costs include indirect material, indirect labor, and items such as depreciation, taxes, insurance, heating, and electricity required in the manufacturing process. Thank you. Okay, this is the end of my presentation. The next presentation will be delivered by my friend. Dah!
Finding life along the way, melodies.
Okay, I will continue explanation about cash flow assumption. A. Identify specific. It is used by identifying each item sold and in the inventory item. The cost of goods that has been sold is charged in the cost of goods sold, while the cost of goods which are still in the hands are included in the supply. This method can only be used in conditions that allow companies to separate different purchases that have been done physically. Next, B. Average cost. The average cost method of calculating the price of item containing the inventory on the basis of the same average cost of goods available during a period. Next, method of merchandise inventory. FIFO, first in first out method. The FIFO method was first recognized in financial accounting as one of the methods in inventory valuation. The price used as a basis for assessing the inventory can use the old price or the new price. The FIFO method of inventory is the recording of the inventory item, which assumes the first supply of entry will be issued and the last incoming inventory will be issued later. Next, LIFO methods. Last in first out. The LIFO method is the recording of the inventory item, which assumes the last purchase inventory unit is used first, and the first purchase inventory unit will be issued in the future. In the LIFO methods, the inventory first notes when the sale in the last inventory entered. In this method has advantage and disadvantage in recording. Next, average. The average method, also called the weighted average method, is the method used to calculate the cost of inventory each unit based on the weight difference of similar unit and unit cost per case over a period. After found the average cost each unit, new cost of goods sold is calculated on the basis of the average price each unit. Okay, this is the end of my presentation. The next presentation will be delivered by my friend.
Okay guys, now I will continue my explain about inventory or store. Okay, next. Okay, now I will explain about cost of manufacturing inventories and impact of production increase. Next. Okay, the cost of manufacturing inventory consists of the three components. Next. 1. Raw materials or raw materials, the cost of the basic ingredients used to make the product. Next. 2. Manpower, the direct labor cost required to complete the finished product. Next. And 3. Overhead, indirect cost in manufacturing process, such as the fraction of manufacturing equipment, supervisor salaries, and infrastructure costs. Next. Cost of acquisition or market value. The accounting principle applicable to the value of inventory are valued at cost or market value. Whicher is lower of cost or market, LOCOM. This assessment can significantly affect currently income and inventory value. Next. Cost of goods sold. In inventory accounting, it should be determined whether a supply is a burden or an asset. If the inventory has been sold, the inventory will be recorded as an expense or component of cost of goods sold. Otherwise, if the inventory is still owned by the company not yet sold, it will be recorded as current asset. And next, according to PSAP number 40, if the goods in inventory are sold, then the carrying amount of the inventory shall be recognized as an expense in the periods of the revenue recognized of the sale. The process of recognizing the carrying amount of inventory sold as expense result in matching lots with revenues. Next. In summary, we can illustrate it as follows. Merchandise sales, cost of goods sold, of inventory, purchase, or return of purchase discount, net purchase, inventory available for sale, inventories, cost of merchandise, gross profit, and next, assessment of supplies with physical system or periodic. Periodic system or physical is at the end of each period. Is calculated physical to determine the amount of ending inventory. The calculation includes measuring and weighting the existing goods at the end of a period to then multiply by a price or cost level. Next, to determine the value of inventory at the end of the period according to the physical system are as follows. 1 is special identity method. 2. Average method. 3. Method of MPKP or FIFO or first in first out. 4. LTKP method or LIFO, last in first out. 5. Basic inventory. Next, assessment of supplies with perpetual system. Next, in a perpetual system, each inventory mutation is recorded in the inventory account. The inventory valuation method is used in the event of a sale transaction by creating a complete inventory card containing the quantity, unit price, the amount of the price for the entry, exit or residual lay. The inventory card is the auxiliary book for every item used or sold. Next. Okay. 1 is moving average method or moving average. 2 is FIFO method or first in first out. 3 LIFO method or last in first out. Okay guys, that is my presentation about inventory or stock, and thank you. Okay guys, this is the end of this video, and we want to say thanks for watching our videos. And on this occasion, we suggest to you guys who are shortly will graduate from high school to choose an accounting department of Gorontalo State University, because studying accounting is fun and because balance is a must. And don't forget to
Like, comment, share, and subscribe.
this video, and see you next video. Bye bye.
Bye.